In the early 1920s, Germany experienced one of the most extreme cases of hyperinflation in modern history. Prices doubled in hours. The mark became virtually worthless, and daily life descended into chaos. Yet amid this economic devastation, a few individuals amassed fortunes that would have been unimaginable under normal circumstances. The very chaos that destroyed the savings of millions created opportunities for the savvy and connected. Hyperinflation acted as a wealth transfer engine. Those holding cash or fixed incomes saw their life savings evaporate. Bank deposits, pensions, and wages were rendered meaningless as the value of the mark collapsed. Meanwhile, individuals who held tangible assets, real estate, commodities, foreign currencies, or precious metals, saw their wealth multiply exponentially. Every day, paper money devalued, but gold, property, and foreign-denominated assets retained or increased in value. Entrepreneurs and traders exploited the situation. With prices rising by the hour, arbitrage opportunities abounded. Buying goods cheaply in one city and selling them at inflated prices elsewhere became a daily practice. Companies that could pivot quickly to essential goods, food, fuel, textiles, turned scarcity into profits. The hyperinflation did not just punish. It rewarded speed, foresight, and strategic positioning. Foreign investors and creditors also benefited. Debts owed in marks became essentially worthless, allowing those who held foreign currency or had lent to Germany to recover far less than expected. Conversely, Germans who owed in marks found themselves liberated from debts they could no longer repay in real terms. The hyperinflation restructured wealth across domestic and international lines in ways few anticipated. The government's response exacerbated inequality. In an attempt to finance reparations and maintain the state, the Reichsbank continued to print money relentlessly. Ordinary citizens were left chasing ever-rising prices, unable to protect savings or purchase essential goods. Industrialists, bankers, and connected individuals leveraged access to credit, insider knowledge, and market positioning to acquire undervalued assets before prices skyrocketed. Every day presented new risks and opportunities. Real estate near transportation hubs, factories, and agricultural land appreciated not in marks, but in tangible value relative to food and labor. Those with foresight converted marks into property or stock in essential industries. Speculators in foreign currency or commodities multiplied wealth in ways invisible to the majority struggling to survive. The hyperinflation also incentivized creative financial maneuvers. Barter systems, private currencies, and early forms of commodity-backed trading flourished. Companies with international connections or access to foreign markets had a distinct advantage. By timing purchases and sales strategically, they converted fleeting monetary chaos into permanent financial gain. Ordinary citizens, unaware or unable to navigate these complexities, lost everything, widening the gap between winners and losers. The second phase of wealth transfer during Weimar Germany's hyperinflation involved strategic acquisition of undervalued assets. Industrialists and bankers, anticipating continued currency collapse, purchased factories, farmland, and commercial real estate with marks that were losing value by the hour. Each transaction was a bet against the currency, and those who acted decisively emerged as the new financial elite. Ordinary citizens, holding cash or fixed income contracts, could not compete. Commodities became another key avenue for wealth accumulation. Grain, coal, and metals could be purchased cheaply before prices escalated. Merchants who controlled distribution channels profited enormously, often overnight. Foreign currencies offered even greater leverage. Individuals with access to US dollars, British pounds, or Swiss francs could buy German assets at a fraction of their real-world value, multiplying their holdings once prices stabilized or currency reform occurred. Some of the most remarkable fortunes came from financial speculation. Bonds denominated in marks became almost worthless, but those who shorted or hedged with foreign-denominated instruments gained significantly. Early adopters of alternative payment systems, barter networks, or commodity-backed credits turned market instability into sustainable wealth. Risk tolerance, information access, and timing determined winners and losers, with the latter often facing total ruin. Debt dynamics played a major role. Borrowers and marks saw obligations vanish in real terms. Entrepreneurs with loans effectively wiped out debt while retaining valuable assets. This created a paradox. Hyperinflation punished savers but rewarded those with debts, particularly when combined with strategic investments. The societal impact was immense, reshaping wealth distribution within a matter of months. Industrial and financial networks amplified these effects. Companies with international reach could source goods at relatively stable foreign prices and sell in a hyperinflated domestic market. Banks with insight into monetary policy or privileged access to government credit could lend, invest, and profit while ordinary depositors watched their savings evaporate. The hyperinflation effectively acted as a wealth vacuum, drawing value toward the well-informed and well-positioned. By 1924, when the Rentenmark stabilized the currency, a new economic hierarchy had emerged. Those who navigated hyperinflation successfully were no longer merely wealthy. They were billionaires in real purchasing power terms. Meanwhile, middle-class citizens, small farmers, and wage earners had lost nearly everything. The redistribution was dramatic, sudden, and largely irreversible. The Weimar example illustrates the systemic nature of wealth transfer during extreme monetary instability. It was not random chaos. It was structured by access, foresight, and strategic positioning. Hyperinflation rewarded agility, information, and connections, while punishing passivity, cash holdings, and traditional saving habits. The few who profited used lessons learned to safeguard wealth in future crises, influencing financial strategies for generations. Ultimately, Weimar Germany's hyperinflation demonstrates that in periods of extreme monetary collapse, fortunes are not destroyed, they are shifted. The invisible hand of hyperinflation redistributed wealth in ways that remain largely hidden from history books, creating a class of ultra-wealthy individuals while erasing the financial security of millions.